They built empires out of code and commerce. Titans who turned startup dreams into fortunes that reshaped the world. Yet last year, when markets were gleaming and headlines celebrated new records, those same architects quietly began to move. In unison, not small reallocations, not routine estate plans. Massive, coordinated sales, tens of billions of dollars flowing out of the market while everyone else cheered the rally. Jeff Bezos converting vast stakes. Bezos converting my stakes. Mark Zuckerberg liquidating billions under preset plans. Long-standing holders, men who held through .com implosions, 2008's banking apocalypse, and the COVID shock suddenly lightening up. The sell-to-buy math that usually hums along at reasonable levels has exploded. Historic ratios, margin, piles, and valuation gauges now scream louder than pundits on TV. This isn't gossip. It's pattern. It's the same signature that appeared before every major market rupture in modern history. What you're about to see is not speculation. It's a forensic map. It's names, numbers, historic echoes, and the cold metrics insiders watch that ordinary investors never see. If these patterns hold, the window to act is narrowing. Not months from now, but within a dangerous year ahead. Stay with me. I'll show you who sold, why it matters, and the exact moves that separate survival from ruin when the ruin cascade hits. They didn't sell because they panicked. They sold because someone pulled a thread only they could see. In the span of a single year, a handful of names that built modern markets began to unwind stakes. Jeff Bezos moved blocks of Amazon stock. Mark Zuckerberg triggered plain sales at record prices. Long-term holders who'd weathered every major crash began to reduce positions. These were not isolated transactions. They formed a pattern. A coordinated exodus. Why does that matter? Because these people sit behind the curtain. They see the wiring. They read proprietary dashboards. They watch daily metrics that never make headlines. When they act together, their trades aren't small personal choices. They are a broadcast signal to the market, loud and specific. Look at the scale. Individual sales climbed into the billions. One founder's tranche alone was measured in high single-digit billions. Across the year, insiders collectively sold sums that rival prior pre-crash years. Data providers who track Form 3/4/5 filings flagged an unusual surge in sell orders. The pattern echoed 2007, the last time insiders unloaded at scale before a market rupture. This is where the story turns clinical. Markets rise and fall on dozens of visible factors. Insider selling is different. It reflects private, forward-looking knowledge. CEOs and major shareholders don't just read earnings reports. They see internal growth, velocity, margin pressure emerging in product lines, and loan performance slipping at the bank level. When those signals align across unrelated firms, you don't have noise. You have a systemic whisper becoming a shout. Psychology matters. For ordinary investors, the narrative is suspense. Did I miss something? That fear pushes headlines, which push flows, which in turn invite volatility. For insiders, the calculus is simple. Preserve capital. Convert paper gains into dry powder. Wait for the reset. It's an institutional survival algorithm more than a headline. Listen to the timeline. Sales cluster in windows. They intensify while prices climb. The market keeps rising because retail money and momentum strategies still buy. Meanwhile, insiders quietly change the composition of ownership. The result? When a trigger arrives, the market can fall faster than typical models predict. It's because the highest information players are already out. We'll unpack the exact metrics. These insiders watch next. We'll show you the two indicators that, historically, flipped the safe. Switch to sell every single time. One of them was created by a Nobel laureate. The other controls margin and leverage across the system, and both are pointing toward a narrow window. Stay with me because the timing is everything. Numbers rarely lie, but sometimes they scream. In 2024, the insider sell-to-buy ratio didn't just tick upward, it exploded. Normally, executives sell 2 or 3 times the stock they buy. It's routine. It's business as usual. Taxes, diversification, personal planning. But when the ratio jumps above 8, that is when history says the alarms should sound. In certain months last year, insiders were selling $9, $10, even $12 of stock for every $1 they were buying. These aren't minor fluctuations. They are echoes of 2007, the year before the last catastrophic market crash. Back then, the sell-to-buy ratio hit unprecedented heights, a harbinger ignored by many until the fall, and today, it reached levels rivaling, and in some quarters exceeding, that infamous year. The implications are staggering. Aggregate insiders selling topped $464 billion in 2024, the second highest year on record. The only year higher, 2007, when $650 billion exited the hands of those with the clearest sight. Consider this. Insiders are typically the most informed investors on the planet. They have real-time access to revenue trends, corporate loan defaults, AI adoption curves, and technology cost pressures. When they sell en masse, it is not coincidence. It is an equation, a signal embedded in data that outsiders cannot fully access. Psychologically, this ratio is a whisper to those who understand it and a thunderclap to those who don't. Ordinary investors watch charts, read quarterly reports, and celebrate gains. Meanwhile, the insider's mathematical signals quietly warn of systemic stress. It's a lesson in market timing, in risk awareness, in observing patterns that repeat over decades. Historical analysis proves it. 8 times since 1975, whenever the sell-to-buy ratio spiked above 8, a major market correction followed within 24 months. 0 exceptions. Not once did the market climb higher before a correction when this threshold was crossed. The numbers, tested and retested by Washington service data, speak louder than pundits. Now, think about leverage. Margin debt, already near record highs at $950 billion, amplifies the effect. When insiders unload, retail investors are still buying on borrowed money. One misstep triggers cascading sales, forced liquidations, and rapid market acceleration toward the downside. And here's the tension. These ratios aren't static. They can spike overnight. One quarter, one sudden filing, one massive tranche of sales. When that happens, the mathematical engine that drives systemic risk begins to hum. The window to act shrinks. Next, we'll map exactly which sectors are bleeding first, the overvalued giants in tech and finance. The pattern will reveal where the first dominoes fall, and who stands in their shadow when the cascade begins. The numbers don't lie, but they do speak in riddles, and decoding them is the key to survival. Some sectors whisper, others scream. In 2024, the insiders weren't selling randomly. Their exodus had a pattern. Technology, finance, the same pillars that historically ignite the first wave of a market collapse. Nvidia, Meta, Amazon, Oracle, JP Morgan. These names dominate headlines, portfolios, and daily chatter. But behind the scenes, executives were quietly exiting at record levels. Why these sectors? History provides a clue. Look back to 2000, the dot-com bubble. Tech insiders sold while the Nasdaq still soared. Stocks with sky-high valuations and no profits were exchanging hands for hundreds of times sales. In 2007, the financial sector led the exodus. CEOs of Lehman Brothers, Bear Stearns, and Countrywide cashed out while toxic assets lurked on their balance sheets. The insiders saw what the public couldn't, the tipping points before the fall. Now, 2024 repeats that pattern. Tech is riding an AI-fueled frenzy. Meta's stock tripled from $90 to over $500. Nvidia surged past $1,000 per share as AI hype and real-world applications skyrocketed. Amazon reached $2 trillion in valuation. Oracle, the backbone of corporate AI infrastructure, nearly doubled. Every indicator of exuberance is visible in hindsight. But insiders sensed the internal pressures: decelerating margins, rising cloud infrastructure costs, ad revenue saturation, and intense competitive threats. Financials tell an equally ominous story. J.P. Morgan, the largest U.S. bank with $3.9 trillion in assets, saw internal loan defaults climbing, commercial real estate delinquencies mounting, and corporate bonds approaching maturity at rates far above the original low-interest debt. For the public, these are statistics. For the insiders, they are red flags, an internal dashboard flashing warnings invisible to everyone else. The pattern is deliberate. Insiders exit the overvalued sectors first. Tech peaks, finance follows. When the first domino falls, the others become unstable. Selling cascades from the overvalued epicenters outward, triggering volatility in secondary markets. It's like watching a forest burn. Fire ignites in the driest trees, then leaps unpredictably, fueled by unseen wind currents. And there is a subtle psychological effect. When the first big names start unloading, the market reacts not to fundamentals, but to fear and imitation. Retail investors chase trends. Margin debt amplifies swings. And the leverage built into ETFs and derivatives multiplies the impact. Next, we'll examine the invisible signals that only the longest-term holders can read. The giants who held for decades and finally decided the peak had arrived. Their actions are the clearest harbinger of a generational market. Top. The exodus is precise, calculated, and the sectors they abandon first are a roadmap of where the collapse will begin. Some warnings are invisible. Some only the masters can see in 2024. The greatest long-term holders, Bezos, Zuckerberg, Diamond, Ellison, did something unprecedented. They sold. After decades, after weathering every crash, they moved billions. This is not just insider trading. This is a signal. A hidden code embedded in their actions. These are the people who have watched markets collapse and recover. Bezos built Amazon from a garage into a $2 trillion empire. Zuckerberg founded Meta and guided it through the AI revolution. Diamond has steered J.P. Morgan through every financial storm for nearly 2 decades. Ellison shaped Oracle into a global powerhouse. They don't sell on emotion. They sell when the invisible metrics scream danger. What are these metrics? Internal dashboards, real-time sales velocity, cloud growth rates, ad engagement trends, loan delinquencies, corporate bond refinancing schedules, margin compressions. Each metric tells a story the public never hears. It's proprietary, forward-looking, and predictive. When combined, these signals create a mathematical fingerprint that precedes crashes. Historically, the market ignores these whispers. Retail investors rely on quarterly reports. Headlines lag. By the time losses appear in public filings, insiders have already exited. In 2007, the same pattern unfolded. Executives sold while public confidence remained high. Months later, the market shattered. In 2024, the data aligns again. Insider sell-to-buy ratios reached extremes unseen since 2007. Sectors are peaking. Tech and financials lead the way. And the long-term holders, the builders who rarely sell, are offloading their stakes. They see what you cannot. The slowing growth hidden behind record profits, the margin pressures masked by accounting, the leverage ticking silently in financial systems. Psychologically, these signals are terrifying. They suggest that the surface stability is an illusion. A carefully curated image of prosperity hides the cracks beneath. And when the first catalyst appears, a bank default, a corporate bond failure, a real estate panic. Those cracks will widen faster than anyone can. Respond. This is why insiders sell early. Not to profit alone, but to survive. They convert a liquid paper wealth into cash, positioning to buy back at lower prices. They are not predicting a crash with guesswork. They are following patterns, reading data, and timing their moves with surgical precision. Next, we'll explore the historical 5-step pattern these insiders repeat, the blueprint that has preceded every major collapse in the last 50 years. Understanding this sequence could be the difference between financial ruin and preservation. The signs are subtle, hidden, but if you know where to look, the message is clear. Time is running out, and the clock isn't ticking for the faint-hearted. History shows that massive insider selling doesn't result in immediate collapse. There's a window, a countdown, between the peak of the exodus and the first domino falling. In 1987, it was 6 months. In 2000, barely 3 months. In 2007, it stretched closer to 12. The pattern is consistent, 6 to 18 months. Enough time for the market to rise deceptively, lulling most investors into false confidence, while those with the highest information prepare to exit. 2024 was the year of unprecedented selling. Billions shifted out of tech and financials. Sell to BI. Ratios hit 9.1 for the year, spiking above 12 in certain months. Aggregate insider selling totaled $464 billion, the second highest year on record, by the historical clock that sets a countdown. From the peak of this coordinated exodus, the crash window opens between Q3 2025 and Q2 2026. That's a narrow 12 to 18-month corridor where the visible forces of the market align for disaster. But it's not just timing. Other factors accelerate the countdown. Corporate debt maturities peak in 2025 to 2026. Commercial real estate defaults rise as mortgages reset at rates far above previous levels. Federal deficits continue to explode, adding systemic fragility. Leverage in retail accounts, margin debt. Near $950 billion amplifies every small movement. Single shock, a major bank failure, a corporate bond default, or a geopolitical crisis could act as the ignition. Imagine it like a high-stakes fuse. The insiders are already at the exit. They sold when the fuse was lit, but before the spark became fire. Ordinary investors, still in positions, are unaware the system is volatile, primed for cascading failure. When it ignites, the market could fall 30 to 50% in months, leaving billions in losses for the unprepared. Psychologically, the countdown builds tension. Every earnings report, every headline, every spike in volatility is a reminder. The clock is moving. Retail investors feel the pulse without understanding the mechanism. The long-term holders. They're watching internal metrics, sales trends, and financial signals, knowing the market is a ticking bomb they can escape. Next, we'll uncover who stands to win and who is destined to lose. The stakes are not equal. The billionaire insiders, who sold at the top, have positioned themselves to multiply their wealth. Ordinary investors, pension funds, and leveraged holders risk ruin. Understanding this distribution is crucial because the pattern repeats and the lessons are brutal. The countdown is not a prediction. It is pattern recognition. And every second that passes moves us closer to the collapse window. In every collapse, there are two sides, the prepared and the unprepared. The insiders who sold in 2024 are not gamblers. They are architects of timing. Bezos unloaded $13 billion of Amazon at its peak. Zuckerberg converted $9 billion of Meta stock to cash. Diamond sold JP Morgan shares for the first time in 18 years. Ellison and the Walton family exited billions as well. They know the system, they understand leverage, and they can read the hidden data that ordinary investors cannot. When the crash begins, Q3 2025 through Q2 2026. According to historical patterns, these insiders will have liquid positions. They will watch from cash as markets collapse 30, 40, even 50%. And then, they will buy back the same assets at half the price. The wealth transfer is surgical. The unprepared lose. The prepared gain exponentially. It's not luck. Strategy, cash is king. Physical gold is insurance. Those who hoard liquidity while others are trapped in equities or leveraged positions can acquire premium assets at distressed prices. The 2008 crisis proved this. Michael Burry earned $700 million betting against subprime mortgages. John Paulson made $15 billion. Bill Ackman netted billions in March 2020. Timing and insight turned fear into fortune. Meanwhile, ordinary investors, pension funds, and the middle class are trapped. Their wealth is concentrated in retirement accounts, home equity, and personal savings. When markets fall, 401(k) shrink, pensions underfunded, home values drop. People who spent decades saving face catastrophic losses. Municipalities falter. Insurance companies strain. Jobs are lost. The ripple effect touches every corner of the economy. This is not hypothetical. It is pattern. The top 1% of holders sold early. The middle class often exits late, panicked, emotional, and at the worst possible moment. Margin calls, leveraged ETFs, and sudden market swings accelerate their losses. Meanwhile, the billionaires multiply their holdings, strengthen their positions, and prepare for the recovery that follows the storm. The lesson is stark. Markets are not fair. They are a system of information, timing, and risk awareness. Those with insight, access, and patience profit. Those without pay. So what can you do? Observe patterns, reduce exposure. Hold liquidity. Invest in safe havens like gold. Build a buy list for quality companies ready to be acquired at half price. Protect income. Prepare psychologically for panic. The collapse will be chaotic, but the method to survive is simple. Stay informed, act deliberately, and understand the signals the insiders already see. The billionaire exodus has begun. The warning signs are unmistakable. The countdown is ticking, and the market is about to remind everyone survival favors those who understand the rules before the game ends. The signs are everywhere. The insiders have spoken with actions louder than words. $50 billion shifted in 2024 alone. Bezos, Zuckerberg, the giants who built empires have begun their exit. This is not speculation. This is pattern. History repeats, and the window to act is closing fast. You can watch from the sidelines, hoping the market defies gravity. Or you can prepare. Reduce exposure, raise cash. Allocate a portion to gold. Build your buy list for when fear grips the market and quality assets drop to half their value. Protect your income. Safeguard your wealth. Position yourself to survive the chaos and thrive in the recovery. Time is the ultimate currency. Every day that passes, the countdown ticks closer to the collapse window. Insider selling has never been this extreme outside of moments that preceded historical crashes. The system is fragile. Single shock, a bank failure, a corporate default, or a geopolitical crisis could ignite a cascade. This is your opportunity to act before panic spreads. Study the patterns, understand the signals, and make informed moves. The billionaire exodus has already begun. Will you ignore the warning? Will you position yourself to survive and prosper? Subscribe now and never miss the secrets shaping our future.